Welcome back to Tip TV Education. Let's talk to Dr. Corvin Codirla. He's a gentleman who's basically managed hedge funds and now is in the art of basically educating people like myself. Right, Corvin, let's go to principle 1 on the next slide if we can. Risk. Tell me about that.
Risk is interesting. Risk is all about how much you're going to lose. So one way to think about it is in the institutional sense. I've got daily P&L swings and I'm looking at value, at risk, VAR measures, etc. But all these are really fictional. The real question is about how much money can I stomach to lose? And so the way I started conversations with potential investors into the fund was always, how much money are you willing to lose? And it's interesting, most people can't really quantify that. And after some time, you realize that 10% seems to be kind of a magical barrier, at least for institutions. But don't kid yourself. Once they're down 5%, the first thing that happens is the phone.
Yep.
Exactly. So risk is really about understanding how much can I lose. But it's more than that, because reducing your losses doesn't actually contribute to your bottom line. Contributing to your bottom line is about taking risk. So what is it that reducing your losses does? It allows you to leverage more. So if you go to the next slide, here's an example of a system that's quite well known by FX traders, which is the London Breakout. So the red line is the London Breakout traded on Euro-dollar since 2010. Part of it is live trading, part of it is back-tested. And so the red line has really no stops other than the opposite side of the range of the trade. The blue line imposes a 50 pip maximum stop. Same position sizes for both systems. And as you can see, we actually haven't made that much more money over the time period we're looking at. So what's the point of reducing my risk? Let's go to the next slide. Now, by reducing my risk, I've done following. I'm losing less, therefore I can leverage more. So let's actually allocate the same amount of risk as the S&P to both the red line and the blue line. And the green line here is the S&P actually since 2010. And by allocating the same amount of risk, meaning the same amount of daily variation in P&L for all three lines, we see that the blue line really just outperforms.
Right.
So by reducing my downside, I'm able to leverage my position size and able to make much more money, which, as I said right at the start, goes back to Source's principle. It takes courage to be a pig. Now, courage comes from self-knowledge and knowledge of the system, and it particularly comes from knowing how much I can lose. If I know that I've reduced my losses, I can leverage up, I can make money. And that is the whole point about risk control and risk management. And that's a fact that tends to get lost within textbooks or as it's taught to people. Risk control is about being a pig. It's not about playing safe. Because otherwise, why are you trading? Otherwise trading becomes just another coupon clipping exercise, which it's not supposed to be. If you look at all the great traders of the last 100 years, they started with small capital and made a lot. And the whole point was they knew they could because they knew their risks.
Understood. Let's move on to principle 2, the edge.
The edge. And going back to what I said, investors ask, what is your edge? What makes you different? What's unique? And what you'd love to tell them, actually, is that who cares how unique I am? I can make you money. Now, the great thing about a retail trader is you don't answer to other investors. You might answer to your wife or your parents or your brother, but ultimately you answer to yourself. So just because you're copying somebody else doesn't matter. You don't have to be unique. Just do something that works. And by God, there's a lot of stuff that works. I mean, I've already pointed out the fact that buying the S&P 500 would have made you money. I mean, just buy it in 2010. By now, you've made at least 100%. I've highlighted commodities as well. They're very well known for trending behavior. Yep. I've taken as an index here the GSE, the Goldman Sachs Commodities Index, and trend following that would have made you money. Of course, the classic example are the Turtles by Richard Dennis.
Yep.
So the real question is, what can we do in Forex? What is it about Forex that gives us an edge? And shall I say in a very naughty kind of way that we can implement in a systematic way that will provide us with long-term growth, which is really the core of what I teach.
Understood. So let's move on to the next slide.
There are three things that drive FX. Interest rates. Why? Well, when you do a trade in foreign exchange, you always trade one currency versus another. So in essence, it's an allocation choice of cash. I want to borrow in one currency and lend in another. And of course, cash is associated with interest rates. So investors always choose those deposit accounts that yield the most. It's also known as the carry trade, of course, and the particularly popular version of that used to be dollar yen or Aussie yen because of the very low interest rates in Japan. Nowadays, of course, euro has become a funding currency. We tend to see that with the negative correlation between euro dollar and the S&P. But understanding interest rates allows you to understand how currencies move. But it does more than that. So people always ask, how do I trade the news? Well, who sets interest rates? Central banks. Why do they set interest rates? Because of their mandate, which usually is price control and inflation. So every news event will affect central bank policy. By understanding how that will affect, I can trade the news. So that's why starting out in my course with looking at interest rates, then looking at central bank policy, and ultimately looking at news gives you a framework within which to understand that. The other thing is value. So imagine this. You go to the States and you buy an Evian bottle. And you come to the UK and this Evian bottle is identical to an Evian bottle down the shop. You should be able to exchange your States Evian bottle versus the UK one because they're identical. Same water, same bottle, same label, same everything. So let's say that the United States bottle was $1.30 and the UK bottle is £1. So the implied exchange rate is 130 for sterling.
Yep.
But in the market, it's 150.
Yep.
Hey, sterling is overvalued if I look at goods. Now, goods prices tend to be sticky, and so we'd expect market prices for currencies to go back to the goods implied prices, also known as the PPP. And ultimately, flows. People need to transact. It's well known, for instance, that euro sterling is affected by month-end flows due to money that has to flow to the European Union. There are corporate flows out of Japan, which affect dollar yen on a regular basis. So momentum is a great indicator. So if you're capable of looking at these individual factors and combining them within the portfolio, you obtain, on the next slide, an index, which is monthly rebalanced based upon the indicators from interest rates, value, and momentum. You trade these currencies appropriately, just as if it were a basket of stocks, for instance, the S&P. In this particular case, it's only 10 currencies, the G10 currencies. And you see that long term, you've had tremendous growth, comparable or even better than the S&P.
Wow.
And that is the whole purpose of the course, to explain that I don't have to be there doing buy, sell on stuff that I don't know why it works or I have a very difficult time explaining why. Here, it's underpinned by fundamental economics. It performs well, has historically performed well, and will continue to do so because I understand why. No, goods will always be exchanged. Money will always flow. People will always chase interest rates.
Understood. Okay, so let's move on to success in trading, risk control, and edge.
We've kept on repeating this message. If you have an edge and you cut your downside, you can leverage up and make a lot of money. It's as simple as that. And the edge, it doesn't have to be rocket science. It doesn't have to be.
Okay. So let's move on to the Tip TV trading education expert. Love that word.
Thank you.
That's your good stuff. Basically, Twitter at FX Master Course.
And here the call to action is do go to the website, sign up to the newsletter. You will be notified on a weekly basis of new articles, new research. The purpose of running the website is as well, I love research. The whole point I came to the city 15, 16 years ago was because I do believe you can make money trading. I've experienced that myself. And the markets are just such a unique, wonderful puzzle that you constantly want to produce new stuff, which you can find on my website, especially if you sign up to my newsletter. I also provide tick data for those people who are crazy about analyzing their own data.
Right.
I provide code via MT4 if people want to have their own go at experimenting. So at the moment, it's growing and it's building a community as well. The one thing that I also do for people who are interested, I do pair up people as trading buddies. Students and mentees. One thing I find is accountability can only be achieved if you have somebody else who looks at your P&L. And it's best to have somebody who's on your same level.
Right.
And this system seems to work wonders in terms of people profitability.
Interesting. And finally, for real-time updates, quotes, and exclusive videos relating to trading education, follow us at Tip TV Education. Okay, Corvin, thank you very much indeed for that. Fascinating stuff. This is going to be the first of a series of sort of teach-ins, for a better word.
Yes.
Thank you for your time.
Thank you.
Thank you.